Welcome back to the podcast, Generate Income by Selling Options. In the previous episode, we explained how the Greeks affect options and what that means for selling options. We introduced the Greek delta and discussed the effect that delta has on options. Let's now dive into a new topic and discuss the Greek gamma. Before we talk about gamma, as a reminder, please support the channel and subscribe to this podcast in order to stay updated on upcoming episodes. And now let's bring in our hosts, Adam and Isla.
Hey everyone, and welcome back for another deep dive.
Always great to be back.
So you're ready to jump into some options trading.
Let's do it.
Okay, cool. So today we're looking at specifically gamma, right?
Yeah.
So try to help our listeners really understand both the risks and potential rewards that are associated with gamma.
Absolutely.
And I'm really excited about this one. For someone who's maybe familiar with options, but maybe they're not quite sure what gamma is,
Yeah.
how would you explain it to them?
Well, I think the easiest way to think about it is like this. You know how delta tells you how much an options price is expected to change?
All right, so like if the stock price goes up $1, how much does the option price go up?
Exactly.
That's delta.
Yeah, so gamma is like the delta of delta. It measures how much that delta itself is going to change. So if you have an option with a high gamma, it means that delta is going to be really sensitive
Okay.
to the underlying price movement.
So it's almost like gamma is like acceleration. Delta is like speed gamma. It's like how fast the speed is changing.
Yeah. If you've got your foot on the gas and you're accelerating quickly, that's high gamma. If you're coasting at a steady speed, that's low gamma.
Mhm.
And if you slam on the brakes, well, that's negative gamma.
Okay, so you're telling me gamma can be positive or negative.
It absolutely can. And that's where things start to get really interesting.
Okay, well, let's dive into that then. Like, what's the difference? What does it mean if it's positive? What does it mean if it's negative?
So if you're long an option, whether it's a call or a put, you have positive gamma. And that means if the underlying asset's price is moving in your favor, your delta is going to become more favorable. But here's the catch. If the price moves against you, that positive gamma accelerates your losses.
Ah, so it's like a double-edged sword.
It definitely is. High reward, high risk.
Okay, well, what about negative gamma then? When do you have that?
If you've sold an option, you have negative gamma. And that works against you when the underlying price moves against your position. Your losses can accelerate really quickly. Let's look at an example. Say you have a call option with a delta of 0.4 and a gamma of 0.05. If the stock price goes up by $1, that delta is estimated to increase to 0.45 because of the gamma. But if that stock price drops by $1, the delta decreases to 0.35. So you can see how that gamma is either adding to or subtracting from your delta as the price moves.
So even though the price moved by the same amount in both situations, the impact on the options delta was totally different.
Exactly. And that's why it's so important to look at both delta and gamma together.
Wow. Okay, so you're making me understand why it's so important to understand this. It's not just about like, oh, how much is the price of this option going to change? It's like, how is that rate of change going to change?
Yeah, it's like looking ahead and trying to anticipate those changes.
Yeah, it's
You
like having like X-ray vision almost into the risk and reward. Okay, so we talked about what gamma is, and we've talked about how it can be positive, it can be negative, and why that's important. But if it can be both beneficial and risky, like how do traders actually manage this? What are some of the ways they use gamma to their advantage?
Well, there are a few key strategies that traders rely on. One approach is simply closing the position before gamma gets too high, especially as that option's expiration date gets closer.
Okay, so basically get out while the getting is good.
Exactly. Remember, gamma tends to be highest for options that are close to expiring and that are at the money. That's when things can get a little unpredictable.
Right, because if the price is hovering around that strike price, near expiration, things could really go in any direction. Okay, so that's one strategy. What are some other ways to manage gamma risk?
Another strategy is called rolling the option. And this just means adjusting your position to try to reduce that gamma exposure. So you could roll to a further expiration date, which usually lowers gamma, or you could roll to a different strike price, depending on your outlook.
Interesting. So it's almost like fine-tuning your position's sensitivity to those price changes.
Exactly. It's like adjusting the dials to get the right level of risk and reward that you're comfortable with.
Okay, that makes sense.
And then there's hedging. You can actually use offsetting positions to create a more neutral gamma profile.
Ah, okay. So if you're worried about too much positive gamma, you could add a position with negative gamma to try to balance things out.
Exactly. For example, if you're short a put option and you're worried about the stock price dropping, you could buy a further out of the money put.
Okay.
This creates what's called a put vertical spread, and that long put will have positive gamma to help offset the negative gamma from the short put.
Well, that's really interesting. So it's all about kind of balancing those positive and negative gammas
Yeah.
to try to find a less risky or a risk level that you're more comfortable with.
Exactly.
Wow. Okay. So we've talked about what gamma is, why it matters, and even some strategies to manage gamma risk.
We have. It's been a lot so far.
But there's one thing I'm still curious about.
Okay.
One of the things that we read in preparation for this was about this concept of actually profiting from negative gamma. How does that work?
That's a great question. And it kind of gets at why some traders actually seek out that negative gamma exposure. Let's think about option sellers. They often have negative gamma, right? Because they're the ones obligated to buy or sell the underlying asset if the option gets exercised.
Right, right. So they're the ones taking on that risk.
Exactly. And if the market moves against their position, those losses can be amplified by that negative gamma. But they're collecting those premiums up front, so they're making a bet that the underlying asset won't move too much, or that it'll move the way they expect.
So it's a gamble, but it's a calculated gamble.
It is. And if they're right, that negative gamma can actually work to their advantage.
Okay. So it's about trying to balance that risk of amplified losses with the potential reward of those premiums.
Exactly. And it's a strategy that can be very profitable if done correctly.
Okay, so we've covered a lot of ground. We've talked about what gamma is, why it matters, how to manage gamma risk, and even how some people actually use that negative gamma to make a profit. But for our listeners who are interested in trying to maybe incorporate this into their own trading, what are some practical tools or maybe some resources that they can use? Like, what should they be thinking about?
Well, a couple of things come to mind. First, option pricing models are a must. These models take into account all sorts of factors like the underlying asset price, the strike price, the time to expiration, even interest rates and volatility. They use all that to estimate gamma.
Okay, so these models can give traders a sense of the gamma for different options even before they place a trade.
Exactly. It's like getting a sneak peek at how sensitive that option might be.
Cool. What else?
Another important tool is your trading platform. Most platforms these days have built-in tools for analyzing and tracking gamma. You can see the gamma of your current positions as well as potential trades all right there in front of you. And speaking of tools, volatility analysis tools can be really helpful when you're trying to figure out gamma risk.
Oh, okay. Volatility is just how much an asset's price fluctuates, right? How does that play into gamma?
It plays a big role
Yeah.
because the more volatile an asset is, the higher the gamma is likely to be for options on that asset.
I see. It's all connected. Okay.
It all ties together.
Cool.
And using all these tools can really help you make more informed decisions about your options, positions, and your risk management strategies.
Wow, this has been so insightful. Thanks for breaking all that down. Now, before we move on, any last words of wisdom on gamma you'd like to share?
It's important to remember that gamma is dynamic.
Dynamic. What do you mean by that?
It's constantly changing as the underlying asset's price moves and as time passes.
Okay, so it's not something you can just like set and forget.
Nope, you've got to stay on top of it.
Got to be actively monitoring it, adapting your strategies. Awesome. This has been great. So now that we've got like a good understanding of the basics of what gamma is and why it matters,
Yeah.
let's talk about how professional traders actually use this. Because it's one thing to understand the theory,
Yeah.
but like, how do you actually apply this in your trading?
Exactly.
And one of the things I found really fascinating is this idea that, we talked about negative gamma being risky, but some traders will intentionally seek out negative gamma.
Yeah, they do.
So how does that work? Why would anybody want to do that?
Well, a lot of it comes down to understanding different option strategies and how gamma plays a role in those. So let's look at a strategy like a covered call, for example.
Okay.
You own 100 shares of a stock, and then you sell a call option on those shares.
Okay, so you're basically betting that the stock price isn't going to go up too much.
Right. You're hoping to collect some premium from selling that call option. And in this case, you actually have negative gamma exposure
Okay, so why is that?
because you've sold that call option. So if the stock price starts going up really quickly, that negative gamma is going to work against you. It's going to amplify your losses.
Because that short call is losing value faster as the stock price goes up.
Precisely. So a covered call writer who understands gamma, they're going to be watching that price movement very carefully, and they might choose to adjust their position if things start moving against them.
So even with a strategy like a covered call, which seems pretty straightforward, gamma still plays a role.
Absolutely. It's a factor in pretty much every option strategy you can think of. Let's take another example. A long straddle. This is where you buy both a call and a put option, same strike price, same expiration date.
So you're basically betting on the market to make a big move, but you're not sure which direction it's going to go.
Exactly. You're hoping for volatility, but you don't care if it's up or down.
And because you have both a long call and a long put, you have positive gamma.
Right. You got it. And that means that as the underlying asset's price moves further away from that strike price, your profits start to accelerate thanks to that positive gamma.
So the further it moves, the faster your profits grow.
Exactly. But remember, the flip side is that your losses can accelerate too if the price moves against you.
It's that double-edged sword again.
It always is with gamma.
Okay, so I'm starting to see how understanding how gamma works with different strategies is really important.
It's like having an extra tool in your toolbox.
Yeah, it's like having a secret weapon.
Yep.
Okay, so before we wrap up this part of our deep dive, what are some of the most important things to keep in mind about gamma? What are the key takeaways for our listeners?
I think one of the biggest ones is just remembering that gamma is highest for options that are at the money and close to expiration. So if you're trading those types of options, you need to be extra careful.
Because that's when things can get really volatile.
Exactly. The price can swing wildly, and that gamma can either magnify your profits or your losses really quickly.
Got it. So gamma is like at its peak power level in those situations.
I like that analogy. And of course, as we've talked about a lot, gamma can amplify both profits and losses. It's that double-edged sword, so you have to know how to use it to your advantage.
Right, and we talked about some of the ways to manage gamma risk.
Exactly. Closing positions early, rolling options, hedging, these are all tools in your arsenal.
It's not about getting rid of gamma altogether. It's about learning how to manage it effectively.
Absolutely. And one last thing to keep in mind. Gamma's always changing, right? It's dynamic. As the price of the underlying asset moves, as time passes, gamma's not static.
So you can't just, set it and forget it. You got to be on top of it.
Always be monitoring, always be adapting.
Okay, cool. I feel like we're really starting to get a good handle on this gamma thing.
I think so too.
This has been another awesome session. We've learned so much about how gamma works, why it matters, and even some strategies to help us manage that risk. But now I'm kind of thinking how does this all actually play out in the real world, right? How do traders actually use this knowledge when they're making trading decisions?
That's a million-dollar question, right?
It is. So I was thinking maybe we could walk through a couple of scenarios.
Sure.
And kind of see how gamma might affect things.
Okay, yeah, I like that. Let's do it.
Okay, cool. So let's say we've got a trader, and they think that a particular stock is about to make a big move. They're bullish, but they're not sure which direction the breakout's going to go.
Okay.
So they're thinking about using a long straddle. We talked about this in the last part, right?
Yeah, good strategy for when you're expecting volatility.
Exactly. So they're buying both a call and a put option with the same strike price and expiration date.
Mm-hmm.
Now, let's say the options they're looking at, they have a really high gamma.
Okay.
How would that impact their decision?
Well, if their prediction is right and the stock does make a big move, that high gamma is going to work in their favor. Their profits could really get amplified.
Ah, okay. So that sounds pretty good.
It does, but there's always a catch. The opposite is also true. If that stock price doesn't move much, or it moves in the wrong direction, then that high gamma is going to accelerate their losses, especially as that expiration date gets closer and that time decay starts to kick in.
So it's kind of a high-risk, high-reward situation.
Definitely.
Okay, that makes sense. So they got to be pretty confident in their prediction if they're going to go with that high gamma straddle.
Exactly. No risk, no reward.
Right, right. Okay, let's look at a different scenario. Let's say we've got a trader and they're short a call option. So they've sold a call option.
Okay.
They're bearish on this particular stock. They think the price is going to go down.
Oh, okay.
And they're hoping to profit as that call option loses value. But let's say the market has other plans. The stock price starts going up instead. Yeah, uh-oh. How does gamma come into play here?
Remember that short options have negative gamma.
Right.
So as that stock price increases, that negative gamma is going to amplify the trader's losses.
So even a small increase in the stock price could really hurt them.
It could. that negative gamma can really magnify things. And this is why it's so important for option sellers, anyone who's short options, to really understand how gamma works, because the market doesn't always go the way we expect.
Right, you got to be prepared for those unexpected moves.
Yeah, absolutely.
So what could this trader do? Like if they're in this situation, they're short this call, what can they do to manage that risk?
Well, a couple of things they could do. One option is just buy back that call option, close position.
Just cut their losses and move on.
Sometimes that's the best move. That eliminates the negative gamma exposure completely.
Okay, that makes sense. What else?
They could also roll that short call option up to a higher strike price.
So they'd still have negative gamma.
They would, but rolling up to a higher strike price will at least reduce the amount of negative gamma. It's like taking your foot off the gas a little bit.
Okay. So it's a way to try to mitigate the risk without necessarily having to close the trade altogether. Okay, so I think these scenarios really help illustrate how gamma can impact trading decisions, in real time.
Yeah, for sure. It's not just some theoretical concept. It has a very real impact on how your trades play out.
Totally. So big takeaway for our listeners is you got to pay attention to gamma.
Absolutely.
It's a powerful force in options trading, and understanding how it works can really give you an edge.
It's like having an extra layer of insight into the market.
It is. All right, folks, this has been an amazing deep dive into gamma. We learned so much about how it works, why it matters, and how to use it to our advantage. I hope you found this episode helpful and informative, and that you can use this new knowledge to become even more successful options traders. We'll see you next time on The Deep Dive.
And that concludes our podcast on gamma. Thank you, Adam and Isla. If you enjoyed the podcast and found the content helpful, then please like and subscribe to this channel. And if you're on the platform X, then please follow us. Our handle is the @ symbol, followed by the word selling, the number 4, and then the word premium. All together, no spaces in between. Thanks for listening.